September 1929. A businessman in Manhattan sensed something was wrong. He couldn't name it exactly. Stock prices had been climbing for years, but underneath all that prosperity, cracks were forming. On a Tuesday morning, acting on pure instinct, he walked into his bank, presented his passbook, and withdrew every dollar he owned, $12,000 in cash, stuffed into his briefcase. 2 days later, the markets collapsed. Banks across the country failed. Panicked depositors lined up outside locked doors, but he was safe because he had his money. Now imagine trying that today. You sense danger in 2026. You try to do what he did. You log into your 401k, $180,000 saved over 20 years. You click withdraw, and a penalty calculator appears. Federal tax, state tax, the 10% early withdrawal penalty. Your $180,000 becomes $98,000 before you see a single cent. But here's what makes it worse. The withdrawal doesn't execute immediately. It enters a processing queue, 7 to 10 business days. During financial panic, those systems can freeze entirely. This is the difference between 1929 and 2026 that nobody is talking about. It's not just that another crash is coming, it's that when it arrives, you won't be able to do what previous generations could. Grab your money and run. Over the next 9 minutes, I'm going to show you exactly what the smartest investors on the planet are doing right now, why your savings are trapped in ways you don't even realize, and the 3 moves that could save your financial life. Let's get into it. Section 1. What smart money is doing. Okay, before I show you why your money is trapped, you need to understand something first. The people who survive financial crashes aren't the smartest or the most connected. They're the ones who recognize the pattern before everyone else. And right now, the pattern is screaming. Let's start with Warren Buffett, the greatest investor in history. The guy who spent 60 years telling everyone to stay in the market is now sitting on $381 billion in cash. That's more cash than Apple, Amazon, Google, and Microsoft combined. But here's what should really terrify you. In the last 2 years, Buffett has sold over $117 billion worth of stock. He cut his Apple position by 67%. He dumped 41% of his Bank of America shares. And for 5 quarters straight, 0 buybacks of his own stock. When Warren Buffett isn't buying his own company, that tells you something. But wait, it gets crazier. You know what Buffett is buying instead? Treasury bonds. Boring, unsexy government bonds. Berkshire Hathaway now owns more U.S. Treasury bonds than the Federal Reserve itself. Buffett owns more treasuries than the Fed. Let me say that again. A 94-year-old man from Omaha owns more U.S. government debt than the U.S. government's own bank. He's earning $13.5 billion a year in risk-free interest, while everyone else is gambling in the casino. And Buffett isn't alone. Michael Burry, the guy who predicted the 2008 crash and made $700 million betting against housing, just placed a $1.1 billion bet against AI stocks. $1.1 billion against AI. He's calling it the Big Short 2.0. Ray Dalio, warning of an economic heart attack by 2027. Jamie Dimon, saying there's a 30% chance of a serious market correction, and he's far more worried than others. Corporate insiders, selling stock at the fastest pace since 2018. Only 151 companies out of the entire S&P 500 had any insider buying this year. So let me ask you something. When the smartest, richest investors in history are all moving to the exits at the same time, what do they see that you don't? Section 2. The warning signs. Here's where it gets scary. There's something called the Buffett indicator. Sounds fancy, right? But it's actually super simple. It compares the total value of all stocks in the market to the size of the entire US economy. When stocks are worth more than the economy produces, things are overheated. Right now, the Buffett indicator is at 221%. In plain English, the stock market is worth more than double the entire American economy. The only time in history it was higher? The year 2000, right before the dot-com crash wiped out 80% of tech stocks. Then there's the Shiller PE ratio. It tells you how expensive stocks are compared to what companies actually earn. Right now, it's at 39.9. That's the second highest reading in 140 years of recorded history. And here's what makes 2026 different from every crash before.
In 1929, when that businessman walked out of his bank with $12,000 in his briefcase, he had options. He could hold cash, buy gold, wait it out. Today, your money is trapped. $7 trillion in American retirement savings is locked behind penalty walls. You can't touch it without losing 35 to 45% to taxes and penalties. Your 401k, 7 to 10 business days to process a withdrawal. During market panic, that becomes indefinitely suspended. Your bank account? Try withdrawing more than $10,000. Federal law requires a currency transaction report. banks can delay for suspicious activity review. In 2023, Silicon Valley Bank collapsed in 36 hours. Depositors with over $250,000 had no access for 4 days. 4 days without your own money. Now imagine that across dozens of banks during a real crash. The 1929 crash took 4 years to hit bottom because people could withdraw and wait it out. The 2026 crash will be faster and deeper precisely because they can't. Section 3. The wealth transfer secret. Now here's the part they really don't want you to understand. Crashes don't destroy wealth, they transfer it. From the unprepared to the prepared. From the emotional to the rational. From those who panic to those who plan. Think about it. After the 2008 crash, while millions lost their homes and savings, a small group of investors made fortunes that lasted generations. They bought real estate at 30 cents on the dollar. They accumulated stocks of world-class companies at prices not seen in decades. Amazon stock fell from $100 to $2 during the dot-com crash. Netflix traded for less than the cost of a monthly subscription. The investors who bought? They didn't just preserve wealth. They multiplied it 100 times, 200 times, some even 1,000 times. This happens in every crash. And here's the opportunity most people will miss completely. When the 2026 crash comes, it won't destroy real value. It'll simply reveal which assets were real and which were illusions. Quality companies will survive. Prime real estate keeps its utility even if prices fall. And investors with cash can buy what others are forced to sell. Section 4. The debt crisis underneath. Now, the stock market is just one piece of the puzzle. Because while everyone watches their 401k, there's a much bigger problem brewing underneath. Debt. Total American household debt just hit $18.39 trillion. That's a record, ever. Credit card debt alone, $1.2 trillion. Average balance, $6,523. Average interest rate, 22.83%. Let me break that down like I'm talking to a 5-year-old. If you have the average credit card balance and only make minimum payments, it takes 18 years to pay off, and you'll pay $9,259 in interest. That's almost 1.5 times the original debt, just in interest. Car loan delinquencies, 15-year high. 1.73 million vehicles repossessed last year, most since 2009. And here's what really gets me. 59% of Americans can't afford a $1,000 emergency expense. Not $10,000, not $5,000, $1,000. Median emergency savings, $500. And 42% have nothing saved for emergencies, $0. Meanwhile, the top 1% owns 31% of all wealth. The bottom 50%, they own 2.5%. 3 people, Musk, Bezos, Zuckerberg, own more wealth than the bottom 50% of all Americans combined. 3 guys, more than 160 million people. The system wasn't designed for you to win, but that doesn't mean you can't. Section 5, the 3 moves. Okay, so what do you actually do? 3 moves. Write these down. Move number 1, build your cash cushion outside the penalty cage. Warren Buffett has $400 billion in cash for a reason. You don't need $400 billion,
But you need something accessible. 3 to 6 months of expenses in a high-yield savings account.
Move number 2, kill your high-interest debt now. If you're paying 22% interest on credit cards while hoping the market gives you 10%, you're losing. That math doesn't work. Every dollar you pay toward 22% debt is like earning 22% guaranteed. No investment in the world gives you that. Move number 3, watch what insiders do, not what they say. The people with the most information are running for the exits. The question is whether you'll follow before the door closes. Here's the bottom line. The warning signs are flashing. The billionaires are moving. The timeline is closing. The choice is yours. If this video opened your eyes, hit that like button. Subscribe if you want more content that actually matters. And drop a comment below. What's your biggest concern heading into 2026? I'll see you in the next one.